Welcome everyone. It's really good to see you. My name is George Prinas. I'm a professor of strategic management here at the business school. But my role today is strictly to facilitate this event. Well, the Open University Business Network is really to help you. So it's a business network with quarterly briefings has been set up to really share our insights into leadership and management and hopefully in a little way help your business to flourish. So it's really good to be here, and on a personal note, I really look forward to all our interactions. I will then just briefly introduce the speaker, Dr. Anna John. I'm very pleased that we have Anna here today. Anna is a lecturer in strategic management here at the Open University as a business school. She holds a PhD from the business school at Dublin City University and an executive master of art in international European relations from the University of Amsterdam. Anna has taught strategic management modules here at the OU and is currently developing a new undergraduate module on strategic management that will launch in October. Anna's interests are mainly focused around two broad themes in strategic management. One is related to cross-border mergers and acquisitions, and the second, which is the topic of today's briefing, relates to non-market activity of organizations. I'm sure Anna will tell you all about it. Just to mention, Anna has a very interesting international background. She taught at a number of universities in Mozambique and has been active in Southern Africa. Before joining academia, Anna has worked as a manager and consultant for companies in pulp and paper, tourism, healthcare, and ICT in Southern Eastern Africa, Central Eastern Europe, and Northern Europe. So, so she has a lot of interesting experience really to bring to the table, I think.
Hello, I'm very happy that you decided to attend this briefing. Thank you very much for coming. So today I'm going to speak about non-market risk. And my presentation will be based on my three publications, two book chapters. Both of them were published by Routledge Company, and one was focusing on non-market strategy and the other was focusing on European business. And also I'll speak about some aspects coming from my recent publication, October 2018, and that publication comes from International Journal of Management Reviews. So obviously, if you are interested, you could find these publications in these sources. So the structure of my presentation will be as follows. First, I'm going to speak about non-market risk, and because my major focus, my specialization is in political risk and political risk management, so I will also introduce political risk as a dimension of non-market activity. Then I'll briefly speak about what political risk is and what constitutes political risk management. Should we manage or not manage political risk? So this will be the major question in part two. Then I will speak about three major approaches to managing political risk. And this will be institutional approach, resources and capabilities approach, and resource dependency approach. So these are three approaches which I have got from my findings in my publications. And then the final part of my presentation will focus on how we could actually use and apply the three approaches and which of the approaches is more appropriate for which context. And also, I will end my presentation with the discussion of how we could combine the three approaches, if they're in conflict with each other, or is it possible to integrate these approaches? Can they complement each other? So this is the focus of my part, final part of the presentation. So this is the structure, the contents of my slides. So if you're interested in, then you could navigate by using this table of contents. So what is non-market risk? Non-market risk comes from non-market activity of different actors in the non-market environment. So different organizations, individuals, interest groups engage in non-market activities. So what constitutes non-market activity? Usually non-market activity is perceived as a bidimensional activity, which consists of corporate political activity and corporate social responsibility. For example, donations, financial contributions might be perceived as important activities within corporate political activities. So these are the examples of what managers might do, what strategists might do in order to engage in corporate political activity. Also, corporate social responsibility has become recently very popular among many companies and small firms as well. I'll bring some examples coming from Marks & Spencer's practices. This is a retail chain which has been particularly active in different social engagement activities. And what is interesting is that they got some new activities, and two examples of them would be an initiative to reduce food waste, and the second is an initiative to reduce the use of plastics, or plastic bags. So quite often if you come to Marks & Spencer stores, you may be asked if you would like to have a plastic bag, but it's not because it's kind of a consumer choice. This is an attempt to reduce the use of plastics. So these two dimensions are interrelated. So what happens in a political environment may occasionally influence what happens in the social environment. So basically these two dimensions are interrelated, and therefore managers try to align these two dimensions when they engage in non-market activity. Political risk is common. It emerges from political environments. So whatever happens in political environment might occasionally cause some political risk. But political risk management, therefore, is a part of corporate political activity. I would like to make an additional comment about corporate political activity in relation to political risk management. Corporate political activity is a broader domain, and it doesn't focus only on risk-related issues in the political environment. It also may focus on some proactive activities, such as trying to forge different relationships with key policymakers, and also trying to enter the market and being the first in the market, entering the market as a first mover. So these are different activities which might be in this domain, and they do not necessarily involve political risk management initiatives. So before we proceed with what political risk is and political risk management, it's quite important to see what are the major elements of political risk. So the definition suggests several elements of political risk. First, this is a possibility that a specific action or inaction in the political environment will directly or indirectly, on a regular basis or episodically, have some negative or positive changes on economic outcomes of firms, both at macro and micro levels. So let's have a look at how we could deconstruct this definition, because it's quite important. This will create some boundaries for our discussion, some framework, conceptual framework for our discussion. Political risk may be considered as the construct which is a probability. So it can be measured, it can be estimated, and therefore it's not the same as political uncertainty. So political uncertainty cannot be measured. But sometimes, even if these two constructs are two different concepts, sometimes they may overlap and merge. And managers and academics may use these two concepts interchangeably. And this happens in the conditions of high political instability, where change happens so fast at very high speed that it's difficult to collect the required information needed to estimate political risk and to make sense of what happens in the political environment. Apart from this, the traditional view is political risk is triggered by actions. It may not necessarily be triggered by actions, so no action is needed to trigger a political risk. So this means that inaction on the side of governments or on the side of companies may also trigger political risk. Some examples: reluctance of a government to take measures against pollution foreign manufacturers may occasionally escalate environmental protests and nationalist movements in the society, and this in turn may put at risk operations of these foreign manufacturers. Also, it might be inaction on the side of companies. So some companies may opt for do-nothing strategies in the political area, and they may prefer not to engage in any negotiations with policymakers. But this may have some consequences, some negative consequences sometimes. So if companies are reluctant to cooperate with governments on some political matters, then the governments may offer and introduce some regulations, some laws, which may not be appropriate for the companies, and they may put at risk operations of their foreign direct investments. So action and inaction both may be important to consider when we speak about political risk. Also, quite often political risk is reduced to governmental risk only, to policy risk. But it's not so, because not only government, but many other actors in the political environment may influence conditions and what happens in the political environment, and may affect how companies respond. So these actors might be rebel groups, transnational advocacy groups, might also be non-governmental organizations, and even some individuals, not necessarily organizations or groups. So I would like to bring an example of how government in Mozambique, for example, it doesn't actually do anything to cause some violent incidents, but these violent incidents happen between civil supporters of the ruling government and the national resistance to this ruling government, called RENAMA, Resistência Nacional de Moçambique. So, and this, again I will repeat, these violent incidents are not really triggered by the actions of the government, so they are happening because civil supporters have their strong views, and they respond to what happens between the two parties. So obviously political risk sometimes is conceptualized as something what happens on a regular basis, and in this case we would speak about something what continuously happens and cannot be removed immediately, it doesn't disappear immediately. And in this case, the best example might be corruption. Some countries they have very high level of corruption, and as a result we could say that they have regular political risk which is quite high. But there might be also violent conflicts which do not happen on a regular basis, might be episodic. They happen over a short period of time, but they may be quite strong, and the impact might be quite strong on what happens with firms. So again, political risk sometimes is perceived as a negative, something negative. So it has this negative color, but it's not always the case, because it may have both negative and positive implications on economic outcomes of firms. And again, some firms may be interested in entering certain markets, but they may not be able to enter those markets because they don't know how to manage political risks in those markets. And this might be perceived as a negative outcome, because firms make a decision not to enter that market, which has some opportunities, but they can't enter because the political risk is too high there. But there are also firms which have capabilities of managing political risk. So for them, entering a risky market might be beneficial. So they know how to manage political risk, and political risk doesn't constitute any threat for them. So they can transform political risk into something positive. So they can avail of business opportunities and protect those business opportunities because they are capable of managing political risk. So obviously, we see political risk without thinking of where it happens, but obviously there is a classification in existing literatures that might be at macro level and micro level. Micro level means that practically all firms affected by political risk. I'll bring an example of Brexit, which means that practically all firms, to some extent, to a greater or smaller extent, might be affected by Brexit in the UK. So their strategies are tailored because of this political risk. Also, micro effects mean that not all firms are affected by a specific political event or some political uncertainty. Instead, a specific firm or group of firms might be affected. Some brands, for example, might be more susceptible to political risk, especially if they belong to states which have quite an active political stance internationally, and this might be typical for some US brands like Coca-Cola. Sometimes is subject to different attacks. There were some recent attacks in India, and if you're interested, I got some more information on this. We've spoken about what political risk is, but it's quite interesting if we really need or do not need to manage it. So do we need to avoid political risk, or do we need to manage it and do something about it and pursue business opportunities in political risky environments? So there are two views which suggest different answers to this question. So the first view is traditional. It dominated practices, managerial practices, and academic research until around 80s, early 90s. And this is a traditional view. So according to this view, political risk has negative implications for foreign direct investments. So this is because until early 90s, in many countries, especially in developing countries, there were a series of expropriations, and governments could disrupt operations of international companies in their markets. So as a result, political risk was perceived as something negative, something which would destroy operations of companies and undermine performance of foreign direct investments. But that was typical at the time of import substitution policies. So governments tried to be more protective of their domestic economies, of their domestic and national interests. So that was typical at that time. And because governments tried to protect their national economies, they also were perceived as a strong authority in the international political environment. So every time a foreign firm would move to a specific market, then there was a probability that it would confront some intervention from governments. So there was a kind of stronger authority of governments. Because of this negative perceptions of political risk and strong authority of governments, firms were perceived as passive actors in the political environment. So they couldn't actually do anything about the political environment, influence it, and affect and influence governments as well. So because of that, the only decision which firms could do, or they thought they should do, would be to avoid political risk. And this means that they would try not to invest into risky contexts. So as a result, the traditional view suggests that foreign direct investments are inherently political, and political risk were a strong determinants of whether to invest or not to invest somewhere. But in mid-90s, we witnessed an emergence of new practices, more economies started to adopt market-friendly strategies and open their economies for foreign direct investments. And because of this, the role of governments has changed. Governments lost their authority compared to firms. Multinational corporations gained their stronger power, and they became very strong actors in the political environment, those which could influence governments, national governments and host and home governments. So basically this view challenged the traditional view. So political risks no longer are seen as those which have negative implications for firms. They may be seen as sources of opportunities. So some firms were quite good at managing political risks, so they could avail of opportunities stemming from political risks. And also, there was quite an important assumption in this modern view, is that not only governments could influence firms, but also firms could influence governments. And because of these assumptions, there was one more assumption coming out. This assumption suggested that firms can actively manage and reduce political risk, and not only reduce, but turn political risk to their benefit. So my co-author, Professor Thomas Lawton, and I, we investigated these two views further, and when we look at these two views in greater detail, we found that there exist three approaches to managing political risk in the international environment, in foreign direct investment context. So these approaches are institutions approach, resources and capability approach, and resource dependence approach. Now I'll speak about each of these approaches in greater detail. Institutions approach. Let me discuss what is the major focus and assumptions of this approach. So this institutional approach focuses on political and regulatory systems. But there are different angles within this approach, because some practitioners might be interested in considering the impact of political and regulatory uncertainty, but there are also practitioners and academics which are more concerned about pressures of political and regulatory systems. What is typical for this institutional approach is that all decisions are considered at the either market entry stage or market exit stage. So it's not clear how this approach may help to deal with political risk when investments are in place, when they are in the markets. So we know what to do according to this approach before the investments are made, and when we need to exit. But it's not clear what to do when the investments are in place. So, as I mentioned, there are two approaches within this broad approach, and one of them focuses on political uncertainty. Political uncertainty, I mentioned, sometimes may be synonymous to political risk. And this is the case in this approach, in the institutions approach. What constitutes political uncertainty? Political uncertainty stems out from opaque regulatory environments, which means that there might be some law development initiatives in place, but the legislation and regulations are quite weak. There's still some voids, regulatory voids, and it's not clear for some strategic managers what to do with these regulations, because there are voids there, so obviously there's lack of clarity. And this is the case of anti-corruption law development in Mozambique. There were some initiatives taken to develop this law 10 years ago, but it still has some voids, and these voids are related to embezzlement, kickbacks, and extortion. So basically these aspects of corruption are not properly covered in this law, and this causes some ambiguity for managers bringing foreign direct investments into the country. How to deal with this is not clear. So another source of political uncertainty is judicial and financial systems under development. So if these systems are underdeveloped, again, this causes some political uncertainty. And the judicial system in Mozambique, for example, is overtasked, and it is prone to influences of local interest groups. So this means that it's not independent as it might be expected in some advanced economies, but it is dependent upon local interests. So it's influenced, and this is source of political uncertainty for some foreign direct investments. Again, another source of political uncertainty comes from different conflicts, military conflicts. There might be also inter-ethnic conflicts within countries which have some political underpinning. The overall conclusion in relation to the impact of political uncertainty is that political uncertainty within this institutions approach discourages foreign direct investments. Usually at the stage of market entry decisions, managers make decision not to enter a politically risky or uncertain market. And also, there are some advocates of the institutional approach who suggest that there's no need to invest into donations and financial contributions in politically uncertain environments, because it might be a waste of money, because it's difficult to obtain the desired results. For example, if a political regime changes, all the investments which were made to the previous political regime will become useless, and maybe even may bring in bad reputation for the company if a political regime changes. As I mentioned, two pillars within the institutions approach. One we have already discussed, it was political uncertainty, and now the second pillar is related to institutional pressures or political and regulatory pressures. How do firms normally respond to these pressures? In order to make sense of the political environment, firms use some kind of managers use some cognitive shortcuts, and they opt for mimicking strategies, which means that they look at best practices, best political strategies of some more successful firms, first mover firms, and then they try to copy those firms. This approach is quite typical for companies coming from collectivistic societies. Like, for example, Chinese companies might be quite attentive to what happens with other Chinese companies who moved first to a particular market. Also, some firms might be interested in what local firms do, so they don't look at other foreign firms, but they might be interested in what local firms do, how they negotiate, how they bargain, how they interact with government. So they try to copy what those local companies do. Well, apart from these mimetic pressures, there are also coercive pressures, which means that there exists some law, legislations and regulations, and firms are expected to comply with these regulations if they want to bring their foreign direct investments into a specific market, and they want to stay in that market. So firms try to comply with the law. I'll bring an example of US firms. The US firms are expected to comply with Foreign Corrupt Practices Act, which was introduced in 1977, and there were some amendments added to that act. And it is enforced by US Securities and Exchange Commission. So all US listed companies, if irrespectively if they perform nationally or if they have operations abroad, they're expected to comply with this act. So even if they bring their operations to foreign countries somewhere abroad, then they still have to comply with this law. So what are the strategies? So I have discussed now two pillars of the institutions approach, but there are also different strategies which managers might opt for if they want to adopt this institutions approach. As I mentioned, all these responses might be quite reactive, passive. So the firm just reacts to what the pressures are in the political environment, and if it's difficult to invest in a specific market, then the firm will desist and will opt not to invest. So this is investment avoidance strategy in this case. I looked at bidding practices of some emerging companies coming to Africa for the first time. They were not always successful because they didn't know how to, for example, bid and how to interact with government officials, how to make sense of information which is supplied to different companies for participation in bidding processes. And so that was quite difficult for some companies, emerging companies in the oil and gas sector, for example. They experienced the bigger difficulties, the stronger difficulties, greater difficulties while bidding. Again, one more strategy which might be adopted, institutional escapism. This means that if we consider a national company, for example, a company is based in its home market, but the pressure on its home market is quite strong, so there are so many regulations, it's so difficult to get approvals of patents, and there are different patent litigations. So the company may opt for moving somewhere else and transferring its operations from the home market to any other market where it might be easier to perform. Also, institutional escapism might be typical for some companies which decided to leave the UK because of the Brexit after the referendum. So this decision was made by such companies like Aviva, and a large portion of assets was transferred by Barclays to Ireland. Also, some companies like Dyson decided to transfer their operations to Singapore, and there are many other examples. So, apart from institutional escapism, as I mentioned, there should be compliance. Like, if the regulations are quite tight, but the company still decides to stay on the market, it will opt for compliance. So, and this is quite a challenge for some companies coming to the market for the first time. For example, companies coming from emerging economies like India and China, if they consider entering the US market, they have to comply with various regulations. And if it's a company in pharmaceuticals sector, or if it's a food manufacturing company, then they have to comply first of all with the regulations developed by Food and Drug Administration, which is a federal agency in the US, which enforces, which proposes, develops regulations and enforces these regulations in order to improve health in the society of the American citizens. So this means that even if companies are not based in the US, but they consider entering the US, they can benefit from consultations of FDA offices in different countries, because FDA used to be based only in the US, but now because it's interested in bringing foreign direct investments on the market, so it's brought its FDA offices to various countries, so that the process of learning about regulations in the sector might become much easier. So we've spoken about the institutions approach, which I would name as a reactive approach. So now I would like to draw your attention to just the opposite approach, and it's resources and capabilities approach, and I would call it proactive approach. So this approach focuses on political resources. It transfers its attention from the external environment to the internal environment, to firms themselves. So it looks into what firms have, and they have different political resources and capabilities. So political resources and capabilities are considered as instruments for managing political risk. So firms, according to this view, can influence political environment and governments. So this is kind of an overly optimistic view that firms can do a lot, and therefore they can enter practically any market. So before I proceed with the discussion of what constitutes the key elements of this approach, I would like to draw attention to what political capabilities are. Political capabilities refer to a firm's capacity to deploy or leverage its political resources on an ongoing basis. So let me bring some examples of what political resources and what political capabilities are. Access to key policy makers may be considered as political resource, but ability to use this access to key policy makers will be considered as a political capability. So another example is that experience in dealing with government officials may be considered as political resource, but a capacity to use this experience in order to maintain and introduce the required regulations, the regulations which are favorable for firms, may be considered as a political capability. So, as I mentioned, resources and capabilities approach is quite optimistic about how political risk can be managed, and therefore it views political risk as an opportunity, not as something negative, something what may destroy foreign direct investments, but something what helps firms to avail of their business opportunities. So firms are no longer constrained by the political environment. They can manage this political environment and go everywhere they would wish to in order to pursue their business opportunities. So, and this means that sometimes some firms which have better bundle of political resources and capabilities are more likely to enter risky environments. So companies which have learned political capabilities somewhere else in risky environments are more likely to enter, again, risky environments. So they will have capabilities to manage this political risk in this case. Some examples come from investments from companies based, originally formed in emerging economies to markets in emerging economies. So emerging economy link is considered. For example, Russia continues to be a highly risky market, but many Russian companies use their political capabilities, which they learned in the national market, in the home environment, to avail of this, to use these political capabilities somewhere else, and therefore they are not deterred by political risks somewhere else, and therefore they are more likely to invest in some riskier environments, like, for example, those in some African countries. Bring some examples like Gazprom, Lukoil, Rosneft, and Rostek. They are quite active in Africa, and they are present in various projects, including liquefied natural gas and energy projects in Angola, Nigeria, and Uganda. Also, if we consider examples from telecommunications sector in Africa, then it's quite clear that there are a number of flaws happening between companies from emerging economies and partners in Africa as well. So Vietnamese Vitel Group has successfully started its FDE project called Movitel in Mozambique. So Vietnam is considered to be a highly political context, and so they have that some companies have quite strong political capabilities to go somewhere else and negotiate access to some markets in other politically risky environments. Another example, Vodacom Group Limited. This company is known for its expansion and growth strategies by investing into politically risky environments. So nowadays it's present in 40 African countries, and some of them are quite risky, like risky contexts like Nigeria, Angola, and also there are some other contexts like Zambia, Kenya, and Cameroon. If we look at practices and research focusing on this approach, resource and capabilities approach, then it's quite clear that all the strategies can be summarized across 3 dimensions. So financial incentive strategy, information strategy, and constituency building strategy. Financial incentive strategy means that firms make donations and financial contributions in order to strengthen their links with certain governments and with certain political parties and policymakers. Also, information strategy means that firms are actively exchange information with policymakers, what the preferences of firms. So they try to communicate these preferences and ideas to policymakers to make sure that they are aware of what are expectations of firms. And they also get information from policymakers, so they're quite proactive in working with the information in the political environment. Constituency building strategy is related and it's kind of connected to the first 2 strategies, so basically they can be used in conjunction. And this strategy implies that firms try to build political ties, political connections with key actors in the political environment. What are the implications for foreign direct investments? And this approach suggests that political risk might be quite positive and good for foreign direct investments, so they are more likely to bring up some positive changes to economic outcomes of firms. So, and for this reason, organizations, firms, do not necessarily need to avoid political risk, so they can turn this risk to their benefit and use it as a source of advantage. But compared to the first approach, this approach has some weaknesses, and one of its weaknesses, as I mentioned, is that it's overly optimistic. It has some optimistic view of resource capabilities as instruments which can actually help firms to achieve anything, practically anything, but it's not true, because there are always contingencies which firms cannot take into consideration, even if they have some political, a broad range of political resources and capabilities. And also, another weakness is, and it was mentioned in some studies, especially in particularly in this study, Sun et al. 2012, and this weakness suggests that some political resources may transform from assets into liabilities. For example, having relations, connections with representatives of former political regime may not be helpful. It may sometimes turn from asset into liability. So once regime has changed, it's much better to think how to act in order to kind of disconnect from those previous interest groups. The third approach, a resource dependence approach, it makes an absolutely different assumption in relation to firms and political environments. So until now, institutions' approach suggested that political environment and governments dominate firms. Then the resource capabilities approach suggests that firms are active players, but in both these instances, we see that the two entities are independent, they're autonomous, kind of they influence each other, but it's not really considered. But this is the approach which considers the relationship between firms and their political environment. So organizations are no longer autonomous. They are embedded into networks consisting of other political actors. So, and the most important point here in this approach is that organizations are dependent on the resources of other organizations. So firms cannot rely on their political resources and capabilities like in the previous approach, but it's not enough for them, because obviously not all resources are available within the firm. And there are some resources which may reside somewhere else, like in other organizations or somewhere else in a group of organizations. And that's why it's important to build the relationships with other organizations. So to see how these relationships are managed, and for this, and this implies managing resource dependence relationships. So what are the key strategies in case of resource dependency approach? First, resource dependence per se doesn't constitute any political risk, but it may constitute political risk if the firms dependent upon each other perform in the conditions of high political uncertainty, high political instability. So that's why there are two ways of managing resource dependencies. First, is the possibility of reducing or avoiding uncertainty, because this is what triggers political risk in the context of resource dependence. Or alternatively, it's possible to reduce dependence itself. So speaking about the first strategy, I mentioned that sometimes emerging companies have difficulties in bidding in Mozambique. And that's why not all of these companies desist from their investments into the country. So they still try to get into the market, but they use this uncertainty avoidance strategy. And for example, Qatar Petroleum is a newcomer to the oil and gas sector in Mozambique, but it doesn't have any experience in working with the INPE, Instituto Nacional de Petróleo. So that's why it refers to help from other companies and partners with other companies, more experienced actors in the political environment in the country. And for example, it recently partnered with Eni to invest into this market. And it has basically a stake in the Angosha offshore block, but it hasn't really led the bidding process. So the bidding was led by Eni. Resource dependence reduction. So there are different ways of how to implement this strategy. For example, companies may try to gain control over some strategically important resources. In this case, they will not need to rely on other organizations. Also, they try to increase their bargaining power. So they might have not that strategic resource, but something else to offer to that organization. So their bargaining power may become stronger. An example of resource dependency reduction is reducing reliance on highly regulated markets. Again, if we look at foreign direct investments to the US market, Israel's Teva Pharmaceuticals Industries is a company which specializes on generic drugs, and it tried to get patenting for Copaxone. It's one of the drugs which has a large share in its portfolio. And there were some patent litigations and substantial delays in these procedures. So it was really difficult to rely on the US market. So the company decided to undertake a series of acquisitions, takeovers on the European markets. And so the example was the acquisition of German target treasure farm in Europe. So what are the weaknesses of this approach? Well, it has some effect of obsolescent bargaining power. So instead of gaining greater control over resources, over time firms may lose their control over resources vis-a-vis governments if they enter specific markets. So the longer they stay, well, the less is uncertain might be if the companies are able to control their access to certain resources, especially to that market. So how can we use these three approaches? This is the final part of my presentation. So some approaches might be more effective in specific contexts. The institutions approach might be more effective in some environments with stronger central authority, more homogeneous. So it may be less effective in some areas with federative structure and some divisions, ethnic or religious divisions. So that's why I would suggest that the best contexts where this approach might be more effective might be Russia and China, because these states have kind of more homogeneous institutional environments. Well, they're federations. Well, Russia is a federation, but it still has quite a strong central authority, which means that its institutional environment is relatively homogeneous. Resources and capabilities approach might work better in some volatile contexts, and also contexts where there's a transition, like a process of devolution of powers from the central authority units to lower administrative units, like in the case of UK. Some volatile contexts where this approach might be more useful, like Venezuela, Ecuador, Nicaragua, Ukraine. So these are indicative examples. Obviously, countries they are not static, so they develop, and obviously they may transition from one group to another. Resource dependence approach might be typical for contexts with divisions due to different reasons. For example, they have federal structure, they have ethnic and religious divisions, they have historical development which resulted in some divisions. In India, each state has unique institutional organization, and it's one thing to negotiate with the central government, with the national government, and another thing is it's quite important to consider interests of some national authorities as well. So this was the case of Coca-Cola. Coca-Cola had to shut down its bottling plant in Mehraj, because there were some protests among local population due to the use of groundwater, and also due to the discharge of some industrial waste. So because of this, the local government had to revoke the permission of the company to continue its operations in the area. Basically, this is the end of my presentation, and I wanted to mention that the three approaches they do not necessarily exist in isolation. We have clear boundaries of what each approach means and what it constitutes, but clearly they are not in conflict with each other. Instead, they might complement each other, and sometimes may use in combination. So some companies may opt for integrating these approaches, like institutions approach may be integrated with resources and capabilities approach. For example, firms may develop such capabilities as institutional embeddedness capability. Also, resource dependence approach may be mixed with resource capabilities approach, and this means that firms may consider developing resource interdependence management capabilities. Institutional approach may be combined with resource dependence approach. It might be useful for managing resource dependencies by means of institutional escapism. So building strategies where to escape if somewhere we've got a very high level of resource dependency. So moving from market with numerous multiple checks, etc., to some other more favorable environment. So this is basically the final slide. Thank you very much.